much, Ben, for coming in, sparing time to talk to us today. It's very good to have you here. I'm wondering if you could start by explaining briefly Jupiter's value-focused investment philosophy and what it means to be a contrarian.
Yes, well, thanks very much indeed for having me. We're value investors, or contrarian investors, if you like, and what that means to us is that we're looking for companies in global stock markets that are lowly valued. So the valuation of their assets or cash flows or profits is low. The reason we believe we should do that is that over time there's a lot of academic evidence over very long periods of time that if you do that consistently, you'll deliver above average returns. Now, it doesn't work every year, and it can have some very difficult periods. And in fact, we've just come out of one very difficult period for value investing. But if you keep on doing it over time, there's a lot of evidence that you will deliver above average returns.
Obviously, on one side of the equation, there is valuation. How do you ensure that the companies are going to live up to expectations over the long term in terms of quality?
So there's always a trade-off, we think. So what we're always trying to do is assess the quality of the business in conjunction with what we're asked to pay for it. So for us, good value can either be, if you like, a below average quality company, but an absolute bargain price, or it can be an above average quality company at a sort of average valuation. So we're always trying to think about that trade-off. We don't think it's possible to either think of quality or valuation on their own. You're always thinking of them together. And when I do the weekly food shop, it's exactly the trade-off I'm doing and everyone is doing. You see different, if you like, food products at different prices, and you're always thinking about that trade-off between can I buy the higher quality? Is that one on offer today? Or the average one, is that one on offer today? And so you're always mentally making that trade-off. And what we're doing is we're always thinking about those two things in conjunction together.
What then does a contrarian approach mean in terms of the sectors and the industries that you've been looking at recently?
I mean, broadly what it means is you're hunting in the unpopular areas that people don't want. Right. Over the last sort of few years, that would include things like mining, oil and gas, some areas of technology which are unpopular. Anything that the stock market decides they don't like, we tend to gravitate there and look and see whether that's correct or not. Now the stock market is very smart over the long run, and there will be areas we'll completely agree with and think, well, no, we don't want to invest in that. But because in the short run, things are driven by human emotions, we're looking for shares that people have sort of shunned, but we think they've been far too harsh and are not keen on them for temporary reasons.
Right. Does that lead you always to out of favour parts of the market?
Yeah. So for us to be successful, we need to broadly buy them when they're out of favour, and then they have to come back into favour. So we're always looking in the areas that people don't want to look in, and those tend to be companies with low valuations. They don't tend to be very popular. People don't want to talk about them, and we tend to look there. Yes.
So how has the portfolio performed over the past couple of years?
Yes. So in the 5-year period to August 2020, value investing, which is what we do, had its worst 5-year period of relative performance to growth investing ever witnessed in financial market history. So that was an exceptionally tough period, whereas the last year or so has been much better. There's been a change in perception in stock markets. I'm not sure what it's driven by. Maybe it might be driven by rising interest rates, maybe a change in the economy, but there's been a change from that period. So it's gone from very, very bad to sort of much better.
And does that mean that you've been able to outperform the index or the benchmark that you use?
So it depends over what period you look. No. So more recently, yes, but before that, no.
But that presumably is the way that the whole thing is set up to work. You're buying when things are unpopular, they're bound to be underperforming.
Yeah. And we've looked a lot into the patterns of performance over long periods of time, and what you can see in the UK funds we run is that we spend a quarter of the entire time underperforming the index. So there are always long periods when we underperform the index, and that just part and parcel of the investment philosophy and process.
More broadly, looking back over 2022, as you mentioned, the rotation out of growth companies, which have become very expensive, and into less fashionable parts of the market, or previously less fashionable areas of the market. How has that affected the portfolio's performance?
So as value investors, that's been good for us. We don't own the highly valued growth companies, and so that's been helpful. Now, clearly that is slightly reversing the prior periods, which have been very difficult for us, where growth companies have performed very, very strongly, and if you like, value companies have been quite weak.
And has it also thrown up new opportunities in terms of investment for you? I'm thinking possibly about giving you access to areas such as technology that was previously just far too expensive for you.
So you're absolutely right. Some areas of technology are very, very expensive because there's a expectation of a lot of growth going forward. But within these very broad sectors, there are always interesting opportunities. So we've got two sizable investments in the technology area, but each of those have got their own issues which they're trying to sort of deal with. So the first one is Intel. Intel has not been run very well. It's fallen behind its main competitor, TSMC in Taiwan, and so Intel is valued very, very lowly indeed, because people don't believe it can get itself back on track with its manufacturing capability. So that's the world's largest semiconductor company, but it's valued on the way we look at it. It would be at a material discount to, say, big oil companies. So you can see how lowly valued that is. A second holding we've got is an IT services company called Kyndryl. That was spun out of IBM in November last year. That's extremely unpopular because no one wanted to invest in Kyndryl. They wanted the dividend from IBM, and it's really a sort of orphan stock. It's just completely friendless. But we think there's a very big turnaround story, and it's the most lowly valued IT services company in the world of a significant scale. And we think that's an interesting opportunity too.
So just to be clear, in all of the stocks that you hold, you're always looking for a potential turnaround?
So normally, to be very lowly valued, something's gone wrong. And so what normally happens, not always, there's probably going to be a management team saying, look, this is what happened in the past, things weren't great, we've got a plan to sort of fix it or improve it, or it will just be a question of the economic cycle going against them. So in times where people are very worried about the economy, more cyclical companies get sort of avoided. So, but normally there is an issue with the company that the stock market doesn't like, hence its low valuation, yes.
What about inflation? It's headline news at the moment, alongside the prospect of rising interest rates and the possibility of economic growth going into reverse. Are you worried about that? Does that affect the companies that you're buying?
At the broader level, rising inflation and rising interest rates are bad news for stock markets, because that means the discount rate on profits goes up, and historically that's been very difficult for stock markets. For value investments, it's a bit less difficult because our companies tend to generate a lot of cash now, but maybe not so much in the future. They don't have such strong growth, so that's a sort of positive. But on the other hand, rising inflation and interest rates is normally bad news for all sorts of forms of corporate profit, because it can lead to recessions, as you say. So I'd say it's mixed. Yeah.
So how concerned are you as a wealth manager about the prospect of global recession?
So recessions are well, over history, I think they come out on average about once every 8 years. So there was a recession in sort of Asia Pacific in sort of 2015, 2016. Clearly, we've had COVID, which is a very difficult period. Before that, there was the great financial crisis. There was the European crisis in 2011, 2012. So difficult periods happen the whole time in cycles. Good periods then have poor periods, and then better periods. They tend to be a normal part of life. Now, recessions are difficult because broadly it means demand falls, profit falls, things are cut, and they're difficult. Unemployment goes up, and they're not nice periods, but they do happen on a sort of regular basis over the course of economic history. So for us, we tend to try and value companies assuming recessionary periods happen. So what is their average earnings power, including recessions? And the second thing that we want to make sure of is that the balance sheet can survive a recession. So as long as the company's balance sheet can survive a recession, you come out of it the other end, and then your profits will recover and your share price will recover. So as long as you price the security assuming those bad things happen at some point, should be okay.
Turning to ESG, environmental, social and governmental considerations, how important are those issues to stock selection for you?
So, if you like, the governance of a firm is always vital, and that has been the case forever, because poor governance will, by and large, probably have serious implications for, if you like, the other two letters you mentioned, the effect on the environment and sustainability. So everything starts with good governance, and from that, the assessment of how the business is dealing with reducing carbon, taking plastic out of the system, making sure the supply chain deals with people fairly, all those broader issues. And for us, they're vital inputs to consider, because if a company has any of those very wrong, it's highly likely your investment is not going to be very successful. So we want to think about those issues, make sure we understand, let's just say the governance has been poor, hence why it's lowly valued, that it's on an improving trend. We want to make sure that the company's got clear plans in place for monitoring sustainability, reducing carbon. So they are very important as inputs, because they are fundamentally could pose a very serious risk, if you like, to the value of the company.
And how important is active engagement with a company? Are you concerned to try and change the way they behave?
Yeah, so the cycle of companies we tend to have is that if something's gone wrong, broadly the management might be changed, and that management will have a plan in place to improve things. And I guess where we debate with them is like what we'd like to see improved, what the sort of time frame of that is, because companies can't be turned around that quickly. And I guess what we want to see is that over the medium term, there's a clear plan in place to improve the business, because that will be good for, if you like, all the stakeholders, whether it's the employees, whether it's the customers, whether it's the shareholders, and if you like, the broader society. So we want to see a clear plan to improve things. Now, if we're sort of not happy, we'll sort of say to them, come on, we want to get better, whatever it is. But broadly, most companies we're investing in, they've got a new management team who are trying to improve things. Yeah.
At a more granular level, are there particular parts of the economy where you're finding interesting investment opportunities at the moment?
So I think it's spread across the market. I mean, there are a few areas where we can't really find that many interesting opportunities. So companies where their earnings are deemed to be, if you like, recession-proof, those are very highly valued at the moment. So there aren't that many interesting opportunities there. So that might be in the sort of food and beverage sector, the daily staples. And there are areas like that, but broadly across the market, there are quite a few interesting opportunities at the moment, but they're spread across a whole range of sectors.
Any examples you'd like to share?
Well, so I mean, I mentioned already we've got two American technology names, Intel and Kyndryl. We've got an Asian bank, Standard Chartered. I mean, my sense is they're spread quite widely, where investors are sort of very fearful at the moment about the next year. So there are, I think, quite a few opportunities around, yes.
On the other side of the equation, presumably, from time to time you make what turn out to be bad calls over the longer term. I guess it's very hard to tell whether they're bad at the time, but are there any examples of those that spring to mind?
Yeah, no, so you're absolutely right. So the evidence we've got from our UK funds over the last 16 years is that, if you like, our hit rate, so successful investments, i.e. companies that outperform the index, is 60% versus 40% that don't. And the key thing there is that the 60% that do well, they do much better than the 40% that do badly. So if you like, you've got a slightly better hit rate, but your payoff is much better in the winners than, if you like, your losses in the losers. So once you understand that happens, we're very sensitive about what is the downside in any investment, making sure they understand that if something goes wrong, how much are we going to lose? So trying to really think about the downside to protect ourselves, because we know we're going to get 40% wrong over time. So we really do think about that mentality. I mean, in the short run at the moment, anything exposed to the economy that's deemed a bit more cyclical is doing very badly. So anything that we've purchased recently, so for example, Intel, that hasn't done very well in the last few months because people are very, very worried about the economy. And what will be interesting clearly to see is what happens over the next 3 to 5 years, for example.
So finally, Ben, could you tell us about a wild card stock that you hold, something that's maybe a bit left field or a bit unconventional, but that you think over the longer term has got a real potential, really interesting potential?
Yeah, so we don't tend to go for wildcard stocks. What we've found over time is the absolute key thing for us is to stick to like a really defined investment process. So how we look for companies, low valuation, acceptable balance sheet, conversion of profits into cash, good franchise. And what we find is the absolute key thing is that we keep on doing that time after time after time, so that the companies that we have share similar characteristics. So you're never going to find that we suddenly have a biotech company. You know, it probably won't have the characteristics that we're looking for. And so we tend to have a selection of securities that all have very similar characteristics. Now, there'll be some companies at any one time that are more well known by people. So, for example, we've got a holding in BP, very well known, big international British-based oil company. And at the same time, we've got a holding in a company called Kyndryl, which is like a company name that probably people have never heard of, but it happens to be the largest IT services company in the world. So we'll always have names that people are more or less familiar with, but all the companies will share the same characteristics as to what we're looking for, because we've found over time that it's only by sticking to that investment process through ups and downs or recessions or good times that we can do a good job for the customers over time.
Well, thank you very much, Ben, for coming in and talking to us. It's been extremely interesting. Thank you.
Thank you very much. Thank you.